Hi there, this is Thomas from investmentexcel.com. In this session I will take you through the valuation of bond techniques. This will include obviously present value, but also zero coupon rates and the yield to maturity. The skills level for this session is stated to be simple, but preferably you have some very basic technical understanding or intuition within math. So this video session and the underlying Excel book are both available on the website investmentexcel.com and also the website spotify.com. Let's get to it. Let's start with some simple cash flow pricing analysis. So what we have here is basically a model for pricing on the yield to maturity curve, which in the graphical setting here is the lower interest rate curve, term structure as we also call it, the blue one, and the other one is the zero coupon rate. We see here in the table the figures. So underlying the term structure of the yield to maturity curve is this range, 1 to 3%, a little bit higher rates than you will find in today's markets. And here we have the zero coupon rates, slightly higher. So now we will look at 4 different models of pricing on each curve, and let's just start with the yield to maturity. I make a box here. I have on the left hand four cash flows, or at least the numerization of the cash flow. I have the years, that is the X on the graph, and I have the yield to maturity, that's the Y on the graph. For each time period, 1, 2, 3, 4, there is a cash flow. It could be dollars, it could be euros, could be yen. And over here, I assume that we have 4 different investors for 4 different cash flow profiles. The first investor, he buys one cash flow 1 year ahead. The second profile, the second investor, buys a second product which has a cash flow in year 1 and one in year 2. So note here, we are not talking about any coupons or any principals yet. It's not specifically a bond, it's just cash flow, because that's very important to note that bonds are simply just cash flows with a special structure. So this one, investor 2, he has a claim on the second and the first one, and of course same with the third and fourth investor. So now what's the price, what's the PV of profile 1's claim on 1,000 1 year ahead? How much is he willing to pay for an expected cash flow of $1,000 1 year ahead? He is ready to pay that price that implicitly gives him the interest rate that he is interested in. That is the return that he is looking for. And the return that he wants is the yield to maturity on year 1. So 1%. That's the required return for investors buying this product. So what we do is just to discount the 1,000 by 1 plus this one, and we lift it to B14, which is just the time period, so we discount it. So if you inverse it, you will see that you get a return of 1%. can also see 1,000 minus 910 is approximately 10 US dollars. Profile 2, as I said, he has 2 claims, and both claims have to be discounted back to time 0, to today, to get the PV. The yield to maturity is a fixed yield that is used to discount the entire cash flows of the bond or the product that we're looking at. So here, for instance, at profile 2, he is looking for a product with maturity of 2. So the interest that he uses to discount is the yield to maturity for that time, and that goes for both cash flows. So D15 1.5 is the discount rate for both. So note that we are not discounting with 2 different yield to maturities. This is something that we do when we come to 0 coupon rates. We have to discount with the same flat interest rate. So here, for instance, profile 3, he discounts with the yield to maturity that applies to maturity 3. This one discounts with the yield to maturity that applies to maturity 4. The total price of that product, the total PV of those cash flows, given the set of required returns implied in the yield to maturity curve, the blue one we see here. So the profile 4, he is willing to pay 3,717.10 to get an expected 4-period cash flow dynamics that looks like this. And how can I be sure that this is the same as the 3%, the requirement that he had? I just said that this is the required return. How can I be sure that this upfront payment for the cash flows in the future, they also reflect the 3%? What we can do is just, for this profile 4 particularly, just take out his cash flows. We know that he will get, or at least expects to get, 4 times 1,000. But he also has some reinvestment of the cash flows that gets to his account. So in 1 year, for instance, this 1,000, they go to his account and it's reinvested. And it's assumed when you deal with YTM that it's reinvested at the YTM yield. So here, the future value of 1,000 in 1 year is the 1,000 times the interest in 3 years. So we have 1,000, we accrue it with 3% first year, and then the interest rate effect on 3% more, and so on and so on. So the last last 1,000 that has to be invested is at time 3, just the previous date before maturity, and 3% will accrue to those 1,000 that is paid on the cash account of the investor. So 1,030, 3% of 1,000, 30. If we just do some simple calculations, calculating the implicit rate, we take the total future value, which is the sum of those 4, divided by the beginning value, the price of the product, and we calculate the yearly rate. So we just lift it up in 1/4 and we get 3%. So this is how the yield to maturity works. The present value using the coupon rates is the theoretically correct way of doing it, because you get exactly what is the required return on each maturity. So you don't have to rely on any reinvestment, any flat reinvestment assumptions. So here we have the curve, and this time we can calculate discount factors for each of the time periods. And the discount factor is just the factor that reflects the required return for that period, not on an annualized basis, but on a total basis. So this is the price for this cash flow today, and this is why we can easily just calculate the total cash flows for each profile like this. Take for instance profile 2, we discount the first year with the discount factor, we discount the second year's 1000 with the discount factor for that year. All in all, we get 4 new prices today, the PV for that cash flows, and as you might see, there is a slight difference between them, and that's because the rates, the two term structures, they have not been calibrated to be consistent with each other. But that works automatically in the financial industry, but I have just typed it in for the sake of simplicity, different zero coupon rates and yield to maturity. Alright, so now we should be equipped to take a step further, going into the price of a bond. And this sheet looks a little bit dramatic, but it's actually very simple. First, you have to note that it's generic, so you can type in anything you like, any characteristic of the bond you like, and the total cash flow will come up here, and all pricing will be done exactly. So that goes to US bonds, European bonds with different compoundings and so on. I have just typed in here one bond, a 20-year bond, 24-year bond, a bullet bond that is just with annual, in this case annual coupons, and then one principal payment at maturity. You see that here. We have the total cash flow. It's a 4.5% coupon bond. It pays off 4.5 each year, and at the last year at maturity it pays the principal at 100 plus 4.5. And the reason why I just took this bond is because I have a print from Bloomberg pricing exactly this kind of bond. So now I'll try to price this with a 2% yield, and I see right here that the present value is 150.95, which is not the present value of the bond, which is 178. If I look into the yield to maturity curve, I can see that this bond is priced on 1%. So if I try to type in 1% as a yield to maturity, I will get a present value of 178, which is 0.35, which is this one, corresponding to a clean price of 175.11. And this is what you see up here from the Bloomberg sheet. So basically what I have done is to lay down, or to come up with the total cash flow on this bond and discounting it with the 1%, and I see that it corresponds exactly to the price in Bloomberg. I can also see here that the yield is 1%. This is yield to maturity. Just note that the bond price, the clean bond price, which is all up here in Bloomberg, corresponds to the present value, the theoretical present value when you discount with the yield to maturity, minus the accrued interest. The accrued interest I have calculated here somewhat vigorously up here to 3.24 for each 100 nominal, and you see that here where it's just per 1 million. So this sheet can be used for pricing of all bonds. It's very flexible, and you can type in here and you can type all the dates in. It's very critical to type in the exact date here on maturity, settlement, and so on. Okay, let's just move to the last step. I'll just try to calculate implicitly the yield to maturity from this particular bond, given that I have an observed price and I observe this in the market. Look, what was the last price of a traded bond of this particular icing code. I have the accrued interest. That gives me a total bond price of 178.36, and if I calculate the cumulated PV with 2%, it gives me 150.95, and the cumulative PV, the PV theoretically has to be the same as the one in the market. So the sum of the spot price and the accrued, they have to give the same as the cumulative PV. So this is basically how the yield to maturity is actually calculated. There is a bond price trading, it gives a certain price, and calculating backwards we get what is the implicit yield to maturity. And here I can guess to get this one to 0. I can, with trial and error, I can see I get closer and closer. I have a little feature here from Solver that can calculate much faster, and you see exactly 1% corresponds to the bond being priced fairly on the yield to maturity curve. So this is how you calculate the yield to maturity. Use the goal seek or the solver to do the trial and error for you, so that the cumulative present value of all your cash flows in the future on the bond are equivalent to the sum of the current observed spot price and the accrued interest. And this goes for all